What else could contribute to this default wave?
We could be in a materially higher interest rate environment than we are right now. And I think that seems to be logical at this point. The Fed will, continue its tapering. Eventually, unemployment will drop low enough that interest rates will be pushed upward, and those will be pushed on to consumers, corporations, and so forth. So those interest rates will rise. So let's just take the absolute most at-risk type of corporation, and that is a corporation that is just barely making it by in terms of its EBITDA number being able to satisfy its current interest payments. And if it comes to market and it can't reduce its leverage because it's gotten used to operating with so much leverage, and it needs to refinance its current package, but let's say the interest rate is now double, they won't have enough EBITDA to go ahead and satisfy that interest payment going forward when they refinance. And so therefore they will be forced into a restructuring. I think that's less the case. That'll be the minority. I think the majority will be, however, that when we get to that higher rate environment, the leverage multiples that the market will accept for purposes of putting debt on these companies may be a lower leverage multiple than has been acceptable in the past. So if I've been levered at 8 times my EBITDA for a long period of time, and lo and behold, I come to market and they say to me, by the way, last time you refinanced it was at X, now it's at 2X, and by the way, instead of an 8 times leverage, you're going to have to come down to a 6 times leverage multiple. Well, that will definitely force a lot of balance sheet restructurings. So, and that's okay. That's a normal shift in the macro environment. What may happen even worse than all that, there may be a very serious contraction in the market for, investing in fixed income. There may not be a lot of what gets us going in these years are retail investors and CLOs, structures that are created in order to go ahead and invest in debt. And those may not come to market. They may not be formed as readily as they are now. So there'll be less demand and more supply, and so therefore that will lead to a host of restructurings and defaults.